Welcome to Building the Future, hosted by Kevin Horick. With millions of listeners a month, Building the Future has quickly become one of the fastest rising programs, with a focus on interviewing startups, entrepreneurs, investors, CEOs, and more. The radio and TV show airs in 15 markets across the globe, including Silicon Valley. For full showtimes, past episodes, or to sponsor the show, please visit buildingthefutureshow.com.
Hi, welcome back. We're live at SUP-X, the Startup Expo, with Mark Volchek, founding partner at Las Olas Venture Capital. Mark, welcome back to the show. I think this is your third time you've been on the show.
Yeah, I think so. Yeah, thanks for having me.
Yeah, of course, man. So maybe before we get into kind of what you guys do at Las Olas, let's get to know you a little bit better. Maybe give us a quick background on kind of where you grew up, where you went to school, how you got to where you are now.
Sure. Yeah, so I grew up in New York as a kid, and then I lived in Europe for a number of years. Okay. My mom's originally from Europe. And then I ended up moving to Connecticut for college. Went to Yale University in New Haven, Connecticut. And from there, I really started my company called Hire One as a senior in college. Very cool. And we kind of took it from there. We raised 2 rounds of angel money, 3 rounds of venture capital. Grew the company to over $200 million of revenue, over $50 million of EBITDA, close to 1,000 employees.
Wow.
And then sold a part of the company to a private equity firm in New York, and then ultimately took the company public in 2010.
Very cool. So what made you found Las Olas, and what exactly do you guys do?
Yeah, so after leaving Hire One after 15 years, I took about 18 months off and then was looking, what I wanted to do next. And I really thought it was very rewarding to work with entrepreneurs and help them build their companies.
Sure.
And so I had been doing angel investing since 2008.
Okay.
And wanted to sort of professionalize that, and got together with Dean, who was one of my partners at Hire One.
Right.
And, he had taken a few years off. He left the company right after the IPO. And so when we got back together, rather than just investing our own money, we said, let's pool money from some friends and family.
Sure.
And then ultimately we expanded that and raised a real fund called Las Olas Venture Capital. And we're currently investing out of Fund One.
Okay, very cool. So what types of stuff do you guys invest in traditionally?
Yeah, so we invest in B2B software, enterprise SaaS.
Okay.
Variety of tools that make knowledge workers more efficient. So we have some investments in the DevOps space, for example, that make developers more efficient. We have some vertical software applications that help companies, automate some workflow or make various functions more efficient.
Okay. No, that's interesting. Is there certain verticals you guys invest in, or it's kind of all over the map?
It really depends.
Okay.
We tend to sort of see things in waves because, different technology enables different things.
Sure.
So like DevOps is something we didn't necessarily expect to get into when we started the fund 3 years ago.
Mm-hmm.
But it's something that, is obviously really important today with developers commanding really high salaries. Making those developers more efficient is obviously a top priority for companies. So that's an example. But we've done investments in fintech, ed tech, vertical SaaS applications, really across the board. But there's certainly some areas we end up liking more, but that can change, year to year, as long as it's in the B2B space.
Got you. And at what stage do you usually like to invest in companies? Again, it's probably a little bit different depending on where they're at, but.
Exactly. So the stage we really define as more as having proven product market fit, which is somewhat of a, gray zone. But what's important for us is the company's ready to scale. Okay. So they figured out, the right product market fit, the right go-to-market strategy, have built out a little bit of the management team and are now looking to raise capital to really scale what's already working and just take that and grow that.
Sure.
But obviously, depending on the opportunity, depending on the team, we sometimes stretch a little bit earlier, or sometimes we'll make investments a little bit later. But our general goal is right at that inflection point where companies have figured out how to make their product and their company work and are looking for a partner for capital and expertise on how to scale from there.
Very cool. So what advice do you give people that are looking to pitch somebody like you guys?
Yeah, so, I think ultimately, the advice for anybody trying to pitch is sort of the same as anybody trying to build a company.
Sure.
It really comes down to building out your team.
Okay.
I think, one person founders are really, really hard to invest in.
Okay.
So, first off, having sort of a 2 or 3 person founding team is preferable. Find some
Okay.
co-founders, but then also build out your management team. So having a 4 or 5 person executive team is often, a lot easier because there's more expertise, more bandwidth to really be able to scale the company from there.
Right.
Additionally, I think it's really important to figure out the right product market fit and then figure out go-to-market strategy for that. And there's many ways to go to market. Not everything is enterprise sales.
Sure.
We've been seeing more and more successful opportunities that are sort of bottom-up, sales strategies. But it also, you can sort of sell to departments and then land and expand and try to get an enterprise contract later.
Right.
So there's a lot of different ways to structure a go-to-market. And that's really important. And it's different for every company depending on the industry and depending on where your product fits in.
Sure. Do you have any advice for people on how to find some of those maybe co-founders or kind of founding team members? Because it's really tricky to find good talent.
Yeah, and especially in today's environment where, talent is very hard to come by. A lot of it's networking.
Okay.
You can certainly go to events, try to meet people that way, but often it's more targeted. So maybe it's looking for people that have certain experiences, have worked at certain companies. And co-founder can, is sort of a range. It doesn't have to necessarily be sort of an equal co-founder.
Okay.
It could be sort of your first VP of sales or your first CTO, and giving them a meaningful equity stake and making them feel like a founder is really important because you want those early executives to be really part of the team and be all in.
Yeah.
And take a lower cash comp in exchange for more equity.
Okay.
And so I think, there's one of our portfolio companies just brought on a COO.
Okay.
And we made him co-founder. We gave him a little bit more equity than normally that role would get. But we wanted to have more people that really think as owners and not as employees.
Sure. Well, and how much do you think giving somebody equity actually motivates them to stay with the company?
I think it's a very important piece for the right people. Equity is really why they're at the company. But I think it's more than just equity. It's really creating the right role for them, giving them the founder's title, giving them broad responsibility, and getting them internally. Founders have this ability internally to bring people together and sort of make an outsized contribution because of their belief in the company and their attachment to it. And so I do think equity is really important. At my company, every single full-time employee had equity, I think, through the first 8 years. And then as we got closer to the IPO, we sort of pared that back a little bit. But I would say the first 300-400 full-time employees all had some amount of equity. And I thought that was really important because as we did, the private equity transaction or as we went public, everybody was excited about it and felt part of that process and we didn't want people to feel left out. So that was really important.
And I also think too, that people feel like they're more maybe appreciated too if they actually have stake in the company. At least in my experience, I think and it's not that you don't care about it when you don't have it, but I think you care that like little bit extra, right?
Absolutely. Having that equity and having that sort of ownership, the sense of ownership and having that responsibility, I think all comes together. So I do think it's a really important tool. And I think, some founders are very worried or don't want to give up equity. And I think that's a big mistake. I think to build a big company, it's important to have lots of partners. And that's, your co-founders, that's your investors, that's your employees, that's your outsourced vendors. Back at our company, we paid our rent, our landlord, with some sort of convertible notes or other things.
Interesting.
Because we wanted them to be part of our success. And so when we wanted to add more space, they always found more space for us. And,
smart.
We paid our executive recruiter that we used for one of our executive roles with equity. So I think giving equity to all your partners is really, really important. And I think being too stingy on equity is a mistake for many founders.
Sure. So do you have any advice for people like how to split that up? I know it's different depending on company and whatnot, but is there kind of a general rule? Like, is it a 20% pool for employees and the rest, or is it kind of depending?
Yeah, there's no easy answer there.
Okay.
We generally target about a 10% option pool. That said, I think especially with co-founders and with other, partners, it's important to just figure out the right capital strategy. And worry less about dilution. I mean, we used to always joke, cash was a limited, resource for us, but we could always issue more shares. Clearly that dilutes existing owners, but it's important to build those relationships. And by paying for services or paying, your employees with equity, you're essentially raising capital from those people, because
Right.
instead of paying them cash, you're selling them shares implicitly. And so I think that's how we think about paying with equity, is essentially making your partners, your employees, investors in your company. And I think that's really, really important.
Yeah, no, I 100% agree. It's interesting because so many people get worried about getting diluted, but at the same time, if the company shuts down, or would you rather get kind of diluted to raise another round of capital, right? And sure, like it's better to own a small percentage of something that's successful than 100% of nothing, right? You hear
Right.
that all the time, but it's just people always worry, I think, sometimes about like, oh, I'm going to lose. It's like, well, maybe, but like you kind of need to do that, right?
Yeah,
It's
I
just
think
part of growing.
Yeah, that's the key of optimizing the chance of success, rather than optimizing your ownership in that ultimate outcome. I think that's another way to look at it.
Sure. So you mentioned to me earlier about speed to market. What's your thoughts on how long should it roughly take a startup to kind of get to market?
Yeah, so I think that again really depends on the
Sure.
company and the product, and how complicated the technology is, how complex the integrations are. Are there regulated industry issues? But overall, I think for founders, the key is to get to market and get to an MVP and get a product out there as soon as possible.
Sure.
So if you can get out there in 6 or 12 months, for most companies today, you can build a basic product in 6 to 12 months and get it out there and start getting customer feedback.
Sure.
And I do think there's sort of a fine balance between, bootstrapping and going slowly versus, when you have something that you think is working and is ready to scale, to really, step on that accelerator and get the company going. Because one of the issues we're seeing is that most companies don't have real defensibility in terms of, patents or proprietary technology. Most companies really win on execution and speed to market
Sure.
and being able to get lots and lots of customers signed up. And so waiting too long, and often see companies that are sort of testing and building product for 3 to 5 years. And
Wow.
many times there's companies, in the major tech centers like New York or San Francisco, the Bay Area, that can raise millions of dollars and just move faster. So they may have started 2, 3 years after you, but if you're too slow, they end up leapfrogging you and moving much faster than you can.
Yeah. Well, and I also think the sooner you get out there, the sooner you start iterating and getting feedback and modifying stuff. And if you spend 3 years or more building a product and then you have to rewrite huge parts of it, that's not fun.
Right.
And then I guess if you don't have, like, you're trying to mitigate, at least in my experience, a big rewrite, right? Like you might throw away your MVP and rewrite the whole thing at some point based on your customer feedback, but it's easier to do that when you spent 3, 6 months on something than if you spent 3 years and you have to throw away that whole thing, right?
Absolutely. I think that's one aspect, is to minimize sort of, or to increase the feedback loop and getting customer feedback. But I think what most importantly is to be able to raise additional capital, you have to
Right.
show traction. And so I think it's a fine line of walking down to sort of, show enough traction to raise the next money, and then use that money to get enough additional traction to raise the next money,
Right.
and really get that growth curve going. Because once you start growing too slowly, you get stuck in this sort of spot where nobody wants to invest in your company and you don't have
Right.
money to accelerate the growth. So it's really important to get on a high growth trajectory and then stay there and execute and perform. And the plan is again different for every company, how fast it can grow, how much capital companies need. But the key is to develop a plan and then really put fuel on the fire and make the company work.
Sure. So do you have any advice for people on how to kind of scale the company quickly? Because that is really challenging.
Right. I think that comes back to, team and people, as we talked about earlier, building a team and building um, that executive team, and then, all the folks around that is really the key to building a great company. I mean,
Sure.
most companies are really only as good as the people involved. And that starts with the founders, the executive team, and then all the employees. And that's really the only way you can scale.
Right.
If you don't have the right team and you start selling too much, customers will be unhappy because things will break. There won't be any support. So the key is to build a balanced company where, you get the sales, but then you also have the support and you can deliver the product in a way that, you end up with happy customers.
Sure. And I want your thoughts on, some companies seem to put their whole kind of product or service in like maybe one or two kind of really talented people. That kind of would worry me, right? Like, I'm assuming your advice is try to get as many talented people across all the verticals, which is extremely challenging, but they can also help you scale based on probably their network and trying to recruit others, right? Like, how do you go about actually finding some of those people?
Yeah, I mean, a lot of it is really networking in your industry, finding some industry people, using your personal network. But it is very, very difficult to find the right people, and it is key to get great people everywhere. I do think, different companies are sort of, the key expertise might vary. So in one company, it could be that having the best data scientists or the best product people is really important because you're going to compete and win on having the best product.
Right.
Whereas in some companies, having the best possible, VP of sales and the best possible sales team matters more, and the product is maybe more generic. And you still want good people building the product, make sure it works. But having, the most brilliant data scientists may not be important for some companies. So it's really important to think about what is your competitive advantage, and then make sure you invest in people in those areas for that, competitive advantage.
Sure. So when you guys are putting money in a company, do you have a certain range that you traditionally invest, or what? How do you guys decide how much money to give a company?
Yes, we generally target a first check of about $1 million.
Okay.
We've done smaller checks. We've done checks as large as 1.5 to start.
Okay.
And then we essentially reserve additional capital for follow-on and future rounds.
Okay.
But that's generally what we target. So it sort of depends on the company, the stage, and often that's part of a round. So we might put in 1 million of a $2 million round, or 1.5 million of a $3 million round. And then it's up to the entrepreneur to fill up the rest of the round. So we will often lead that. We'll issue a term sheet, and then the entrepreneur works to sort of find co-investors. And sometimes, and we certainly work with them. So we make introductions. We often bring people with us that can jump on board.
Okay, interesting. How important is it? Like, there's obviously a life cycle of a fund. How important is it to kind of get in early compared to maybe later in a fund? Because if you're looking to raise additional capital and your company's willing to maybe put in a second round, if it's kind of late in the funds, what's your thoughts on when to kind of is ideal for you and for a startup to get investment from you guys?
Yeah, so we really try to make it sort of not relevant by reserving enough capital. So even our last investment, if we reserve correctly, we should have enough capital to do those follow-on investments.
Okay.
Clearly, it's a little bit advantageous. If I was an entrepreneur, I would prefer to be earlier in the life cycle of a fund because one, that you have more patient investors. Most funds have a life duration of 10 to 12 years.
Sure.
So if you get an investment in year one, no one will be in a rush to sort of create an exit. Whereas if somebody invests in year 4 or 5 of their fund, you have a duration of 6 or 7 years left. So it matters a little bit, but I think the most important is to find the right partners, the right investors, and I think smart, well-run venture investors will manage that on the background, and entrepreneurs don't need to worry too much about that VC life cycle.
Okay, and then I'm assuming that if you started a second fund, you would potentially use money from that second fund in some of your first fund investments, or how does that work?
Actually, that's generally frowned upon by institutional investors because since your investor base is different between different funds, you don't want to be sort of accused of supporting Fund 1 investments with Fund 2 money because it could be different investors. So generally, that's why what we do is we reserve a significant chunk of money in Fund 1 and we'll roll over and start investing out of Fund 2, even though we may still have $5 million left in Fund 1, but that's all reserved now for existing companies.
Got you.
We also have ability to leverage that a little bit. We can borrow against the fund. If we have an exit, we can use some of the money from the exit to reinvest in the other companies. So there's different ways to manage that life cycle, but generally the cross-investing across funds is frowned upon by institutional investors.
Okay, no, that makes sense. And so you say 10 to 12 years. Why is that kind of a life cycle of a fund?
It's really because investors ultimately want to get their money back.
Okay. Sure.
And so our goal is to invest the fund generally in 3 to 5 years. I think for Fund 1, we'll actually be fully invested in 3 or 3.5 years.
Okay.
And that gives us, 7 to 8 years to work with all the companies and ultimately create returns. And there are ways to extend the life of the fund. You could distribute, if there are investments left over at the end, you can either distribute those, you can sell them to a special purpose fund. There's lots of ways to create that.
Sure.
But institutional investors and, individual investors want to see some, deadline on return of their capital with gains.
Sure. Well, and I think it seems like more and more companies now are taking close to maybe 10 years to either get acquired or IPO, where it used to be maybe like 3-4 years companies were trying to exit. But it seems like the life cycle of a company now has kind of been extended. Do you agree with that, or what's your thoughts on that?
I think that's right. I think, we're seeing holding durations, for investments become longer. At the same time, I think there are more and more options to sort of, sell positions to private equity firms, to sort of create liquidity for investors without an exit.
Okay.
And I think most entrepreneurs and most investors don't take enough advantage of that, because there's so much private equity money out there that for successful companies that are generating, significant cash, there's actually a very liquid market of private investors who can essentially, buy out earlier investors,
right,
or buy a third. Like at Hire One, we sold a third of our company to a private equity firm, and we used all that money to buy out early investors, including management.
Okay.
So we were able to take some money off the table. And I think that's an important tool that still not enough people think about, that you can create liquidity without actually creating an exit.
Interesting. But we're out of time. So where people can get more information about you guys?
Sure. LasOlasVC.com.
Okay.
So that's LASOLASVC.com. And that's the best place to learn more.
Perfect, Mark. Well, I really appreciate you again taking the time to be on the show, and I'm sure we'll keep in touch, and have a good rest of your day.
Great. Thank you.
Thank you. Okay. Bye. Cool.
Good.
Thanks, dude.
Good. Thank you.
Thanks for listening. Please visit our website at buildingthefutureshow.com to join the free community, sign up for our newsletter, or to sponsor the show. The music is done by Electric Mantra. You can check him out at electricmantra.com and keep building the future.